Hello and welcome to a fresh new edition of Trading Hour. I'm Prashant. With me, my colleagues Reema and Pavitra. Guys, hi. Good morning. Reema, of course, is standing on the big wall, and I don't know if you can show her. IT, of course, is the focus area over the next couple of days, and we'll get you what to expect from the top IT services names, starting TCS early next week in just a bit from now. Markets doing nothing. It's pretty quiet out there, although in the first 2 hours or so, we've already seen a fair bit of move. I mean, the market started lower, then the market went up. There was a sell-off. And we are there now, down 50 points, 17,941 or so. In very simple terms, the level to watch really is yesterday's low, which is 17,961 or so. We will see if those levels by close are held or not. It's too early in the day to kind of say if the market is able to hold on to these levels or we see further correction. But 76 points lower, we are at about 17,915 right now. Reema, Pavitra, good morning.
Hi, good morning. Like you pointed out, there's been quite a drop from the top. And a bulk of this pain is actually coming through from the banking names, right? So a few of those will be up on your screen. This is something that we saw play out yesterday as well. So those stocks in focus. What is doing well, however, are the consumer names. So that is actually the only sector which is holding up in the green. So some of the larger names will be up for you. Reliance is also another one which is, really adding some support to the markets. That one is looking good. And the insurance space continues to do quite well. So something like an HDFC Life once again is doing well. For the week, it's up 9%. Even something like an SBI Life has seen a 4% move. So do watch out for that space. On the downside, like I said, it's tech and also the banking space. In terms of cues, we will get the US jobs report today. So that is important to watch. And then, of course, earnings season kickstarts on Monday. So it will be a lot about IT. But speaking of that, like I said, it is going to be IT which kickstarts earnings season for us on Monday. TCS will be first to go on the 9th. And then we will have Infosys and HCL Tech on 12th and Wipro on the 13th. The big question is the slowdown easing or worsening, and is the slowdown already priced in after the 30% underperformance last year? Reema's moved over to the big wall, and she is here with all of the key expectations from big tech in Q3. Reema.
Thanks so much for that. So let's tell our viewers what we can learn and hope to learn in this quarter's results and commentary. Now remember, Q3 is typically a soft quarter seasonally. But this quarter, growth rates will further moderate given the higher furloughs. Remember, HCL Tech has already highlighted that we are seeing higher furloughs in 3 key verticals. They spoke about high-tech, BFSI and telecom. Now let's pull up the CNBC TV 18 estimates on the growth expectations this time. The top 5 IT companies are anticipated to report a growth anywhere between 0.5% going up to 3.5% for HCL Tech. But if you compare with this December of last year, where the growth rates averaged from 2.5% going up to 6.5%, you would see that growth is slowing down. That's point number 1. So what do we want to hear from the management to understand the future demand? 1, will the furloughs continue into Q4 as well? 2, how are the tech budgets for this calendar year? If the tech budgets are flat, and if they're not growing, and if large deals are absent, can IT companies see double-digit growth next year? Number 3, is there a moderation in the deal win outlook? And what about pricing? Is pricing under pressure? And finally, watch for the hiring numbers because they are a proxy for future demand. Now let's talk about the margins and the expectation. Now the CNBC TV 18 poll throws up that margins are likely to expand for the second consecutive quarter for the IT companies. This is aided by an INR depreciation and 2, declining attrition. So TCS's margins are likely to expand by 70 basis points. For Infosys, margins are likely to go up by 30 to 40 basis points. Now, while margins are improving, a point which has been made by the IT bears is that margins are still significantly off compared to the peak levels that they hit post-COVID. Remember, in the immediate aftermath of COVID, IT companies had cut back on hiring, salary, travel costs were zero, and margins had surged. Now, the question is there scope to improve the margins from current level, given that attrition is on a declining trend? Or will growth offset any margin improvement because you need operating leverage to kick in to improve margin? Now let's talk about the guidance. The annual guidance is given by Infosys and HCL Tech. Infosys is likely to retain its FY23 guidance on revenues and margins, and so is HCL Tech. HCL Tech, in fact, just last month had already tweaked its guidance, right? They had indicated that growth rates this year will be at the lower end of their guided band. So don't expect any change. Wipro gives you a quarterly guidance, and next quarter's guidance is likely to be muted at 0 to 2%. But as we've been saying, the question is really on future demand, FY24 and FY25. And here, unfortunately, the results are unlikely to give you any strong quantitative signal on FY24 outlook. And then let's move on to the stock price and valuations. Now, last year, the Nifty IT underperformed. The Nifty IT index was down 25% versus the Nifty, which was up 5%. Now, the Nifty IT has underperformed the markets consecutively only once in the past 15 years. So will this support a trend reversal? Can Nifty IT recover? Or given the fact that despite the correction, valuations are still at a premium to historical levels, will we see valuations correct back to their pre-COVID levels, driving a weakness in the stock? Back to you.
All right, Reema, thanks a lot for taking us through that complete roundup on what is expected from the big tech companies in Q3. But to discuss more on this, we're also joined by Devang Bhatt of IDBI Capital. Devang, good morning and thank you very much for joining us. This is Pavitra. I'm sure you